Since hitting its peak in June of 2022, inflation has decreased each month. The February number is 6%, down from January when the inflation rate was 6.4%. And January was slightly slower than the 6.5% rate seen in December. Going back 14 months to January 2022, the inflation rate was 7.5%. All these numbers, including February's 6%, are above the 2% rate the Federal Reserve desires. Price of airfare, lodging, gasoline, and food all went up in February, but at a slower rate than going up in January. This tells us inflation may take longer than expected to come down. So how does it impact the bank turmoil we've seen in the past week? Former Federal Reserve Governor Robert Heller joins me. Good evening, sir.
Good to see you, Greta.
Nice here. All right, the Federal Reserve is trying to slow down an overheated economy, the inflation. And they do it by interest rates to control that. Is there any indication that there's a link between the quarter-inch or the quarter-point increase in by the Federal Reserve a month ago had any impact whatsoever on what we're seeing in the banking community?
Well, it was the entire process of raising interest rates for the last year, roughly, that lowered the value of bonds, especially long-term bonds, in portfolios out there that were banks' holdings. And so the value of these bonds declined, and that led to part of the demise of Silicon Valley Bank.
Is that something the Federal Reserve should, I mean, I'm not excusing the behavior of the bank or the decisions the bank made, but is that something the Federal Reserve should have anticipated or seen was likely to happen?
Well, clearly, when you raise interest rates, values of bonds will drop. Actually, the Federal Reserve's own portfolio lost over $1 trillion during the last year, because they were also holding long-term government bonds, and the value of those bonds declined. And so at the present time, the value of all the Federal Reserve bank assets is a negative $1 trillion. Let that sink in for a second. The Central Bank of the United States actually has a negative value, and it reflects exactly what happened to Silicon Valley Bank. And to top it off, the CEO of Silicon Valley Bank was a director of the San Francisco Federal Reserve.
Is this alarming to you? I mean, are you worried that this is going to metastasize, or is this sort of a contained crisis?
No, the overall banking system in the United States is in very good shape indeed. We had accumulated a lot of capital in the banks. They're all well capitalized. And Silicon Valley Bank was really a bit of an outlier because they invested very heavily in that long-term investment portfolio in securities, I would say, that were considered very safe. U.S. Treasuries, mortgage-backed securities, things of that sort. But the value of that portfolio dropped because, as we said before, interest rates went up. The value of the portfolio, of the existing portfolio, will go down. And that's what the problem was at Silicon Valley Bank. But Silicon Valley was really a unique institution in that regard.
When you say it's an outlier or unique, isn't it though? I mean, they didn't spread the risk by their portfolio, so they basically they rolled the dice on it. Seems to me they didn't have a very diverse deposits, for instance. Is that something that the bank regulators don't have authority to monitor, or didn't do something about it? I mean, what's the role of the bank regulators in this?
The bank regulators might have pointed it out to them. A prudent banker will have not a mismatch in its portfolio. If we think back a little time, in the mid-1980s, the entire savings and loan industry in the United States was wiped out because of a maturity mismatch. They had short-term liabilities to their depositors, and they had long-term mortgages that they were holding on their book. And when interest rates rose under Chairman Volcker at that time, the value of that portfolio dropped. And as a result, like I said before, the entire savings and loan industry was wiped out. It has happened before. People have short memories.
Well, we're now expecting or anticipating that the Fed is, because we still have an overheated economy, we still have inflation, we're not at that ideal 2%. We're expecting that the Fed is going to raise the interest rates more at its next meetings. I mean, that's what the expectation is. Does that, and so that's going to probably, weaken the bonds even further. So doesn't that create even more pressure on the banks that hold these?
That's absolutely true. I would say the Federal Reserve might want to pause or have only a very, very small increase for the present time while these fires are burning right now across the economy. Wait a month, and then after everything has calmed down, the financial system has regained its footing, then you may continue the fight against inflation, which you absolutely have to do, because inflation over the long run, if it's not wiped out, it will destroy really the fabric of the society.
Robert Heller, thank you, sir.